There's a financial system operating right now that controls more dollars than exist in America. It's not run by the Federal Reserve. It's not regulated by U.S. banking laws. It's not backed by FDIC insurance, and most people have never heard of it. This system, called the Eurodollar market, holds deposits estimated at $13 to $15 trillion according to various financial analyses. That's roughly the size of the entire U.S. commercial banking system. These are real dollars, moving through real transactions, funding real businesses and governments. But they exist in a shadow realm outside the control of the institutions supposedly managing the dollar. Welcome to the invisible empire, the parallel financial system that makes the global economy work, and that could destroy it. The story begins in the 1,950 seconds in the aftermath of World War II. Europe was rebuilding. The Soviet Union was accumulating dollars through trade, and a problem emerged that would accidentally create one of the most important financial markets in history. Soviet banks held significant dollar deposits, but they feared the United States might freeze those assets for political reasons during the Cold War. The USSR needed somewhere to hold dollars that was beyond U.S. government reach. The solution appeared in London. British banks, particularly Moscow Narodny Bank, began accepting dollar-denominated deposits. These weren't pounds. They were actual U.S. dollars, held in London rather than New York. The deposits sat outside Federal Reserve jurisdiction. They weren't subject to U.S. banking regulations. And crucially, they couldn't be frozen by U.S. authorities without British cooperation. This was the birth of what would become known as Eurodollars. Not because they had anything to do with the euro currency, which wouldn't exist for decades, but because they were dollars held in Europe outside the United States. What started as a Cold War workaround became something far larger. Corporations discovered that Eurodollar accounts offered advantages beyond political safety. U.S. banking regulations in the 1,950 seconds and 1,960 seconds imposed reserve requirements and interest rate caps on domestic deposits. Eurodollar deposits faced no such constraints. Banks could offer higher interest rates to attract deposits and charge lower rates on loans. The market exploded. By the 1,960 seconds, Eurodollars had become the preferred funding mechanism for international trade and investment. Here's where it gets interesting. Eurodollars aren't just dollars sitting idle in foreign accounts. They're lent out, creating more dollars in the process through the same fractional reserve mechanism that domestic banks use. A London bank receives $1 million deposit. It keeps a fraction as reserves and lends out the rest, say $900,000. That $900,000 gets deposited in another bank, which lends out most of it. Each iteration creates new dollar-denominated credit, expanding the money supply, beyond what the Federal Reserve alone creates. The crucial difference is that the Fed has no direct control over this process. When U.S. banks create money through lending, they're subject to Federal Reserve oversight. Reserve requirements, capital regulations, stress tests, and monetary policy transmission all constrain domestic money creation. But Eurodollar banks operate in foreign jurisdictions. A bank in London or Singapore or Tokyo can create dollar credit based on its own country's regulations, which are often more lenient than U.S. rules. The result is a massive parallel dollar system that functions independently of Fed policy. Estimates of the Eurodollar market's size vary because the market's offshore nature makes precise measurement difficult. According to data from 2016, the Eurodollar market was estimated at approximately $13.8 trillion. Current assessments suggest the market continues at similar levels, around $13 to $15 trillion in traditional deposits, according to various financial analyses. Before the 2008 financial crisis, some estimates placed the market even higher. Research examining the broader offshore dollar system, including not just deposits but credit commitments and derivative contracts, suggested figures approaching $93 trillion, according to Bank for International Settlements data, though this encompasses a much broader definition than traditional Eurodollar deposits. Think about that. An unregulated offshore dollar market operating at scales that rival or exceed the regulated domestic system. This parallel system serves real economic functions. International trade gets financed through Eurodollar credit. Multinational corporations fund operations globally using Eurodollars. Governments borrow in Eurodollar markets. The system provides liquidity and efficiency that pure Fed-controlled dollars couldn't match. A Japanese company buying German machinery can arrange dollar financing through banks in Singapore without ever touching U.S. soil. This flexibility has made Eurodollars essential to global commerce, but that flexibility comes with risks that most people don't understand until crisis hits. The The 2008 financial crisis revealed how fragile the Eurodollar system could be. When panic struck, Eurodollar liquidity dried up almost instantly. Banks that had been lending to each other for decades suddenly refused. The problem was trust. Eurodollar transactions rely on counterparty confidence. There's no Fed standing behind them, no FDIC guaranteeing deposits. When banks couldn't determine who was solvent, they stopped lending entirely. The freezing of Eurodollar markets created a vicious spiral. Companies and governments that relied on rolling over Eurodollar loans couldn't access funding. This forced liquidation of assets to raise cash, driving down prices, triggering more panic. The Federal Reserve, recognizing that Eurodollar seizure threatened the entire global financial system, took extraordinary action. It established dollar swap lines with foreign central banks, essentially providing dollars to institutions beyond its direct control. The Fed became not just America's lender of last resort, but the world's. This arrangement has profound implications for American power and vulnerability. On one hand, the Eurodollar system extends U.S. financial influence globally. Transactions happen in dollars, giving America leverage over international commerce. Sanctions become more effective when they can cut off access to dollar funding. Countries need dollars to trade, creating perpetual demand for U.S. currency even as America runs persistent trade deficits. On the other hand, the system creates dependencies that constrain U.S. policy. When Eurodollar markets face stress, the Fed must respond even though these are foreign banks making loans beyond U.S. jurisdiction. The Fed's balance sheet becomes backstop for global dollar creation. This was evident during 2008 when swap lines extended Fed exposure to institutions it doesn't regulate. It happened again in 2020 when pandemic panic triggered another Eurodollar squeeze and the Fed reopened emergency lending facilities. The opacity of Eurodollar markets amplifies systemic risk. Domestic banking is transparent. Regulators see balance sheets, conduct stress tests, monitor lending standards. But Eurodollar transactions happen through offshore accounts with minimal disclosure. When a Cayman Islands bank makes a dollar-denominated loan to a Korean conglomerate using deposits from Middle Eastern sovereign wealth funds, U.S. authorities have limited visibility. The dollar flows, but the risk accumulates in shadows. This became particularly dangerous as the shadow banking system evolved. Shadow banking refers to financial intermediation that occurs outside traditional regulated banks. Hedge funds, money market funds, special purpose vehicles all conduct banking-like activities without banking regulation. The first Eurodollar market became core infrastructure for shadow banking, providing dollar funding that these entities couldn't access through traditional U.S. banks. According to Financial Stability Board estimates, the global shadow banking system peaked at $62 trillion in 2007, declined during crisis to $59 trillion, then rebounded to $92 trillion by 2015. Much of this shadow banking infrastructure relied on Eurodollar funding. When Eurodollar markets seized in 2008, shadow banking collapsed, triggering the cascade that nearly destroyed the financial system. Yet after the crisis, after the bailouts, after the regulatory reforms, the Eurodollar market continues operating much as before. It's too embedded in global commerce to shut down, too useful to participants, too profitable for the banks involved. Recent developments suggest the system's structure may be changing. Post-2008 regulations increased costs of holding Eurodollar deposits. Basel III capital requirements forced banks to hold more capital against dollar assets. This shifted some activity back to U.S.-based selected deposits, which are similar to Eurodollars but held within U.S. regulatory jurisdiction. Some analysts suggest the Eurodollar market has contracted from peak levels, though measuring this precisely remains difficult given the opacity. Technology introduces new variables. Blockchain and tokenization could potentially replace Eurodollar plumbing with more transparent systems. Some proposals envision tokenized U.S. treasuries serving as collateral for offshore dollar transactions, bringing visibility to flows currently hidden. Major financial institutions are experimenting with regulated liability networks using shared tokenized ledgers for settlement. If these systems mature, they could fundamentally reshape how offshore dollars function, potentially giving U.S. authorities more control while maintaining the efficiency that made Eurodollars attractive. But transitions of this scale take years or decades. For now, the Eurodollar market continues as the invisible engine powering global finance. Every time you see a headline about international trade, foreign direct investment, or emerging market debt, Eurodollars are likely involved. Every time global markets face a dollar shortage, as happened in 2008, 2020, and periodically since, it reflects Eurodollar system stress. The market operates continuously, creating and destroying dollar credit, responding to demand signals, all without direct Fed management. This creates a paradox at the heart of global finance. The dollar is America's currency, but much of the world's dollar supply isn't controlled by American institutions. The Fed sets interest rates and manages monetary policy domestically, but it can't directly control how foreign banks create dollar credit. When global conditions demand dollars, the Fed must supply them through swap lines and other facilities, even to institutions beyond its regulatory reach. When dollar liquidity dries up, the consequences hit globally, forcing Fed intervention to prevent contagion. The system's sustainability depends on confidence. As long as participants trust that dollars are valuable, that counterparties will perform, that the Fed will provide liquidity in emergencies, Eurodollars function smoothly. But that confidence is fragile. Any shock, geopolitical crisis, major bank failure, sovereign default could trigger a run on Eurodollar funding. When participants lose confidence, they hoard dollars, refusing to lend. This scarcity drives up borrowing costs, forces liquidations, and creates the very crisis everyone feared. Some analysts warn that a severe dollar shortage could trigger a rip-your-face-off rally in the dollar's value, making it dramatically more expensive to repay dollar-denominated debts. Countries, corporations, and banks that borrowed in Eurodollar markets would face impossible burdens. Defaults would cascade. The interconnected nature of global finance means failures in Eurodollar markets could topple entire financial systems. This isn't guaranteed, but it's possible. And the Eurodollar market's opacity means we wouldn't see it coming until too late. The invisible empire persists because it serves too many interests to dismantle. U.S. financial institutions profit from intermediating Eurodollar transactions. Foreign banks gain flexibility and higher returns. Corporations access cheaper funding. Governments find willing lenders. Everyone benefits during stable times, but invisible empires, by their nature, conceal risks until they materialize catastrophically. Understanding the Eurodollar market means recognizing that the global financial system operates on two levels. The visible level, where central banks set policy and regulators enforce rules, and the invisible level, where $13 to $15 trillion circulate beyond direct control, creating liquidity and risk in equal measure. As long as the system works, most people never think about it. But when it breaks, as it did in 2008, everyone suffers the consequences of infrastructure they didn't know existed. The empire isn't going away. It's too deeply embedded in how global commerce functions. But it remains vulnerable to the same forces that have destroyed financial systems throughout history. Excessive leverage, opacity, interconnection, loss of confidence. The next time you hear about a global financial crisis, remember the invisible empire operating in the shadows. Chances are, it played a role. If this changed how you see the dollar and global finance, hit that subscribe button. The most powerful systems are often the ones nobody talks about. Understanding them might not prevent the next crisis, but it might help you see it coming.